Flip a coin 10 times. You get 7 heads. Does that mean the coin is biased? Flip it 100 times, 62 heads. Now you're sure something's wrong. Flip it 10,000 times, 5,047 heads. Suddenly the coin looks perfectly fair again. That's not luck correcting itself. That's the law of large numbers, one of the most misunderstood ideas in probability, and one of the most expensive misunderstandings in investing. Here's the version most people carry around in their head. If something hasn't happened enough times yet, the universe will balance it out. Red hasn't hit on roulette in 8 spins, so red is due. A fund manager beat the market 3 years in a row, they must have skill. Your stock dropped 3 days straight, a bounce has to be coming. That version is wrong. And confusing it with the actual law of large numbers costs people money every day. The real law of large numbers, in plain language, says this. As you repeat an independent random trial more and more times, the average of your results gets closer and closer to the true expected value. Not that individual outcomes become more predictable. Not that streaks get corrected. Not that the next flip balances the last one. Just that the asterisk running average asterisk converges toward the true probability if the trials are actually independent and the setup is stable. Let's make that concrete. A fair coin has an expected value of 50% heads. Flip it 5 times, you might get 5 heads. That's 100%, wildly far from 50. Flip it 50 times, you might land around 44% or 56%. Flip it 5,000 times, you'll almost certainly be within a percent or two of 50. The asterisk individual flips asterisk are still 50-50 every single time. But the asterisk sample, average asterisk, tightens around the truth as n grows. That's the law, average convergence, not streak reversal. This distinction matters enormously in finance. Take stock market returns. The S&P 500's long-run average annual return is roughly 10%, depending on the period and whether you include dividends. But any single year can be minus 30 or plus 30. Over 5 years, you might still be nowhere near the historical average. Over 30 years, the range of outcomes narrows dramatically, not because bad years get paid back, but because one catastrophic year gets diluted across decades of other outcomes. Investors who understand this hold through volatility. Investors who confuse it with the gambler's fallacy sell at the bottom because we're due for a correction, as if the market keeps a ledger of fairness. Casinos understand the law perfectly. The house edge on roulette is small, a few percent. Any single spin is nearly a coin flip for them. But they don't need to win your spin. They need you to spin 10,000 times. Over large N, that tiny edge becomes a mathematical certainty. The casino isn't hoping red or black balances out for you. It's counting on the average converging to asterisk their asterisk favor. Insurance companies work the same way. One house burning down is unpredictable. 1 million policies across a country, the payout ratio converges toward an actuarial table. That's why they can price premiums below the expected disaster cost for any one customer and still profit. Large N, stable probabilities, independentish events. Now here's where people get hurt. They see a mutual fund beat the index 4 years running and call it skill. But with thousands of fund managers, randomness alone produces a handful of 4-year winners every cycle. Exactly what you'd expect from the law of large numbers applied to asterisk who asterisk gets labeled a genius. Most of those streaks mean revert in performance, not because the universe balances talent, but because the initial streak was partly noise that gets averaged out over a longer sample. They see a meme stock surge 300% and treat it like a coin that's hot. Momentum exists in markets for real structural reasons, but the gambler's fallacy version of "it's on a run" is not the law of large numbers. Past price moves don't converge toward a fair coin unless there's a genuine economic anchor pulling them there. They see a crypto token launch, watch early buyers win, and assume the sample of 10 winners represents the expected value. It doesn't. Small n tells you almost nothing. The average of 10 launches tells you what 10 launches looked like, not what 10,000 will look like. So what does the law of large numbers actually give you? 3 useful things. And one thing it explicitly does asterisk, not asterisk, give you. It gives you confidence in asterisk aggregates asterisk. Insurance pricing, casino margins, long horizon index investing, polling with large samples, quality control in manufacturing. It gives you skepticism toward asterisk small samples asterisk. 3 years of fund outperformance, 1 viral trade, a week of coin flips, a Reddit thread of 10 success stories. It gives you patience. If your strategy has a genuine positive expected value, the law says the average payoff reveals itself over repetition, not on the next trial. What it does not give you is a prediction for the next event. The coin doesn't know its history. The roulette wheel has no memory. The market doesn't owe you a green day because you had 5 red ones. 3 questions to test whether you're using this idea correctly. 1. Am I looking at an asterisk average over many trials asterisk, or trying to predict the asterisk next single outcome asterisk from a streak? 2. Are these trials actually asterisk independent asterisk with a asterisk stable probability asterisk, or has the setup changed? A coin doesn't change. A company's fundamentals do. A bull market's distribution is not the same as a recession's. 3. Is my sample size large enough to infer anything at all? Or am I treating 10 data points like 10,000? Quick recap. The law of large numbers says sample averages converge toward true expected values as n grows. It does not say streaks reverse, luck balances out, or the next flip compensates for the last one. That's the gambler's fallacy, and it's expensive. Casinos, insurers, and long-horizon index investors profit from large N. Day traders chasing do moves and investors chasing hot streaks often pay them. The universe doesn't keep score of fairness on individual events. It only reveals the math when you zoom out far enough. If breaking down the probability ideas behind financial decisions is useful to you, subscribe. See you in the next one.